day, I want to say a word about the news that came out today relative to the economy. Actually, I just want to say a number. 0. Today, we received news that our economy had 0% inflation in the month of July. 0%.
We expect inflation to return to 2% while the labor market remains strong.
Can we definitively say peak inflation's here?
I think yes. Today's action is what peak inflation looks like. We got a consumer price index number that was down versus last month. And what happened? Well, the Dow roared 535 points. S&P surged 2.13%. And the NASDAQ pulveted 2.89%.
House of pleasure.
Or to put it another way, peak inflation is nirvana for stocks, especially for out-of-favor stocks like fast-growing tech plays, financials, consumer discretionary names. That means you can buy everything from Microsoft to Wells Fargo to Target and even to Disney. I know we're worried about the Fed, but before we panic about the Fed like Mr. Ludnick, I think, would have had in the previous segment, they may be winning. I mean, tomorrow, CPI, they may be winning. Why do we presume that it has to go up, and up, Carl, when it's entirely possible that the only thing really left is wage and food? I have Costco on tomorrow. They're one of the biggest companies when it comes to food. What if food goes down? What if the wages stall? Meaning just we don't get any more increases. Then I think we put in the bottom on a lot of stocks. Too bullish? Yep. Carl, I don't think so.
Well, Credit Suisse is forecasting that inflation will collapse over the next 12 to 18 months. Jonathan Golub is behind the call. He's the firm's chief U.S. equity strategist. Jonathan, great to speak with you.
You think inflation is peaking and about to cool dramatically. Why do you say that, and how do you filter what Esther George and Waller say to the contrary?
Well, one, I think there's an extraordinary popular delusion, Tyler, that we have entrenched inflation. I mean, if you look at every metric at the moment, and it's possible next week we will see a negative CPI print, given the big drop that we've seen in gasoline prices over the last 87 days.
The former Fed official, Bill Dudley from the New York Fed, he was on yesterday saying that he thinks the equity market has it wrong, that the Fed is going to have to do a lot more tightening. You're going to take the other side of that. It's a tricky thing to fight the Fed.
So the inflation news is really on the ground, really coming in really well. On the ground, things are looking so much better.
The second thing is inflation. And Scott, I have not been ready to say this while a lot of people have been calling for the peak of inflation.
Don't do that.
But I think now we have more and more evidence that inflation might actually be peaking.
So I'm not here to call a peak in inflation. I wouldn't be the person to do that.
A few moments later.
But that sounds a little bit out of control. I think you're going to see that subside. I think that unlocks a portion of the market that becomes more viable because maybe expectations have finally caught up with reality. And whether or not we peak in overall headline inflation, in the components that matter, we've already not only peaked but are rolling over.
Housing, which has been the one thing that people consider quite sticky, and saying shelter could be inflated through the end of next year, is already starting to roll over when you look at the high-frequency data like from Redfin or Zillow. And, 42% of the CPI basket of price indices are already deflating from their peak. I mean, that's a pretty huge number. So I think that investors should be encouraged that the price sort of impulse of rising prices, I mean, that's hit some sort of wall. We think it's actually going to fall pretty quickly.
Yeah.
But it looks like inflation is proving to be a lot less sticky and maybe even more sensitive to gasoline falling because of how gasoline moves through the services CPI. And if that's correct, then we are tracking more towards a soft landing that's more like 2018. And that would mean markets have already discounted much of the Fed tightening. And so we would want to be buying this rally. But in the past week, we've gotten some data that I think really shows inflation could be falling far faster than expected.
In my early days in my career, in the early 80s, when Volcker was taking a sledgehammer to inflation because it was embedded in the system after 15 years of profligate spending, Vietnam War, Great Society, and then going off the gold exchange standard. A sledgehammer, that's what he needed. That is what I believe Chairman Powell thinks he needs. And we just don't think that's true because we see so much deflation. And then one more thing.
Rick Santelli, hopefully you've got the numbers for it.
Yes, the August numbers for the Consumer Price Index. Headline number expected to be down is up 0.1 instead of down 0.1. And do remember, the high water mark there was in June when it was the highest level since 2005, when it was up 1.3%. Up only 0.1, of course, is the lowest. Well, since last month, we're unchanged. If we strip out the all-important food and energy, and do understand, gas was down, 26% month over month. It's food that we have to pay attention to, up 0.6%, double the expectation.
All right. Today is Tuesday, September 13th, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. What a day, what a day, what a day in the stock market. A bloodbath across the board. Big tech is down. Oil and gas down. Banks down, Chinese stocks down, software down, chips down, industrials down, everything is down. And this is what happens when the bulls become too arrogant and they run the tape way too high before the reading, as if they know what the reading is gonna be. Now look, the bulls had a good argument, which is, hey, gasoline prices are down, inflation CPI should come down, then the dollar goes down, and I was locked and loaded to trade that way. But I was also prepared to trade the other way, which is exactly what we got today. What we covered in last night's video, the data from Adobe was a spot-on leading indicator to what took place in the CPI today. Now, we're gonna go over all of these details and a lot more in tonight's program, but before we start, I have a couple of notes. Note number one, in last night's video, I was covering the options market and I was explaining the open interest, and I had an example with a stock that is traded at 300. Meanwhile, I was showing you on the screen the options grid for Apple, which caused a lot of confusion. My bad. As I was editing the video, I thought about it. I thought that this is going to be too confusing, but I was running out of time. It was 9 o'clock here, Pacific time. Do I spend 5 to 10 minutes creating a new slide, or do I get the video to you right away? And I chose the latter, and that caused a lot of confusion. But rest assured, we're going to cover it again in another video. Note number two. Last week, I said that Regeneron, the stock, has a dividend. That was a mistake. I might have confused it with AbbVie. So to clarify, Regeneron doesn't have dividend. Now, with that out of the way, let's move on to the main topic of this video. And here it is, in focus tonight. Here comes Nero. Burn it down. Burn everything down. Inflation is out of control. And the only remedy left for the Fed is to burn it down. And by the way, isn't it ironic that we're trusting the arsonist Jerome Powell and the Fed to put down the fire that they started? Anyways, here's the data that we got today. Monthly U.S. consumer prices unexpectedly rose in August. I would say we kind of expected that, at least the viewers of this channel. Anyways, as gasoline prices were offset by gains in the costs of rent and food, giving cover for the Fed to deliver another hefty interest rate increase. Look at this. While gasoline prices went down, inflation in energy is cooling down indeed. This is the bulls and Team Transitory Inflation's biggest mistake. They concentrated too much on the drop in gasoline prices and energy commodities, but they did not factor in this. Yes, energy is down, gasoline prices down month over month, airline tickets down month over month, fuel oil down month over month, and used cars prices went down slightly month over month, but everything else went higher in price month over month Once again, month over month. We're not talking even year over year. Utility prices, the bills you're paying, that went higher by 3.9% month over month, ladies and gentlemen. Apparel was higher by 1.7%, electricity 1.1%, and most importantly, shelter, aka rent, according to the CPI, this was up by 0.8%. Now, we all know that the reality of rent inflation is at least year over year above 25%. A month over month, I would say that number went higher by more than 5%. Here, on the ground, in real life. But even with the cooking from the kitchen at the CPI, this was the largest monthly increase in owner's equivalent rent since 1990. But rest assured, the pumpers at JP Morgan, aka the Landromat, they say don't panic, everything is okay, inflation is still peaking. Take a look.
It's a little warmer than expected, but I'm not going to call 0.1% of an increase in prices a hot inflation report. What's happening is it's cooling. There are just a few hot spots. There are problems in getting all of inflation to come down, but the cooling trend is there. I think markets are overreacting to this. In particular, there's a big chunk of inflation, the CPI, 32%, is in shelter, and that's up 0.7%. And that's really what's driving a lot of the underlying resilience of inflation here. But a lot of that is, owner's equivalent rent. It's a very, almost a mythical concept because nobody actually pays owner's equivalent rent. So,
hey, buddy, be thankful that the CPI is actually using owner's equivalent rent and not actual rent inflation, because had they used that, the CPI would be at double digits right now. Look at rents, for example, for one bedroom in August of this year. In New York, it's around $4,000. Once again, one bedroom. San Francisco at $3,000. San Jose, almost $2,800. San Diego, almost $2,600. LA, almost $2,500. And it goes on and on and on. Who the hell can afford all of this? And the problem is, with mortgages rising higher, that adds more demand for rents, which means that rent inflation will continue to move higher and higher and higher. And by the way, I say that JP Morgan is in a reputational crisis right now. Their coked up analysts and strategists have been urging investors to buy the dip since October of last year, while other institutions have been cautious. Just last week, the Landromat said that stocks are unlikely to test the June lows as the market gets a boost from cooling inflation. Wow, this is what cooling inflation looks like. And folks, this is month over month, not even year over year. The prices of cereal up 1.2%, sugar up 2.4%, flour up 2.2%, ham up 1.3%, potatoes up 2.5%, white bread up 2.6%, non-white bread up 1.7%. What's up with the discrimination over here? I guess white bread has white privilege. That's why it's up more than non-white. But anyways, canned fruits up 3.4%, uncooked beef up 1.3%. If you want cooked, that'll cost you a little more. Margarine up 7.3% month over month. I mean, is this Zimbabwe or what? Pet food up 1.7% month over month. And unfortunately, a lot of pet owners are deciding to get rid of their pets, actually abandoning their pets, because it's not just pet food that is going higher. It's also the cost of healthcare. When you go to the vet, you're paying an arm and a leg. What about eggs? Up 3%. Once again, month over month. Frankfurters up almost 5%. Oranges up 1.5%. Olives up 4% month over month. Wow. And in case all of this is depressing to you and the Irish genes start to kick in and you look for some bottled therapy, well, that's going to cost you about 0.4% month over month. Tobacco up 1.1%. Donuts, even donuts, up 2% month over month.
Motherfucker.
Your gas bill, that's up 3.5% month over month. Electricity up 1.5%. The cost of health insurance up 3.5%. Window covering up 3.7%. Car insurance up 1.3%. With all the crime and the theft of catalytic converters, oh yeah, the cost of insuring your vehicle will go higher, and so is the cost of fixing your car. That was up 1.7% month over month. Even women underwear went higher by 1.7% month over month. So all of you ladies who are selling underwear on OnlyFans, no judgment from me, but you gotta charge a little more because the replacement will cost you more. But hey, the good news is women dresses went down in price by 4.6% month over month. I guess no love for dresses anymore, right? And folks, inflation is really bad. Forget about the CPI. We have certain cities in America where actual people live where inflation is at double digits territory. The city of Phoenix, inflation is above 10%. Atlanta, Miami, even Baltimore. We have a lot of cities where the rate of inflation exceeds the CPI. Some of these cities include Chicago, Seattle, Houston. Yet the geniuses continue to talk about peak inflation, and inflation is not a big deal, and the Fed doesn't have to tighten anymore, yada, yada, yada. But this is the result of inflation. Average hourly pay in America, adjusted to inflation, went down 2.8% in the past year. So net, everybody's losing money to this inflation. You might be getting a bump in your hourly pay, but the rate of inflation is a lot higher. And if these criminals actually accounted for the rate of rent, for example, real wages in America would be down by over 10%. Have you noticed that your paycheck doesn't cover for shit anymore? Well, this is the reason. And people are getting frustrated when we look at the polls. More people are now saying that inflation is causing them to have financial hardship. Last year, 45% said severe to moderate. Fast forward to today, and we have 56% say that inflation caused them either severe or moderate hardship. We look at income. Those with lower income, less than $48,000 a year. In November of last year, 70% said that inflation is causing financial hardship. Now 74% say that. And even among the middle class, earning between $48,000 and $90,000, we have a net increase of about 17% who now say that they're facing financial hardship. And even among those earning more than $90,000 a year, the number is up by 12%. Who now say that they're facing financial hardship due to inflation. But hey, rest assured, the Joey B administration say that today's CPI report reflects progress in taming U.S. inflation. Are you kidding me?
What a stupid son of a bitch.
And this might be a little hard to see. You might want to pause and take a screenshot and magnify it a little bit. But basically, they're asking, how does the rise in inflation, the rise in prices around you for necessities such as rent, utilities, grocery, etc., how is that impacting your spending habit? How is that impacting your consumption habits in the economy? Well, about 24% of those say that they have reduced spending, and they're limiting spending on essentials only. 17% say they canceled a vacation and they do less traveling. 17% say less driving, less usage of gas. 10% say they're eating out less. 8% say they're staying home. 8% say they're cutting down on entertainment, social activities, and fun money. In other words, folks, when we talk about inflation, I've been explaining this to you for how many videos now? The natural evolution of the cycle of inflation is it starts as inflation. We have the honeymoon phase of inflation. Wages rising higher, corporate margins rising higher, everything is hunky-dory. And then little by little, we get to the ugly stage of inflation, where prices rise too high to the point where the rate of growth in inflation exceeds the rate of growth in wages. And that leads to stagflation. Inflation becomes stagflation because people have to spend less in the economy. So the pace of economic activity slows down. And the worst kind of inflation is rent inflation. Why? Because once you sign a new lease, your rent goes higher by 30%, you're locked in. You're locked in for a year. And that chunk of your income that you're now paying for rent, well, you're not spending that in the economy. You're not buying stuff. And that causes inflation to stay higher while the pace of economic activity slows down, and hence stagflation. A little by little, stagflation becomes a recession. Why does it become a recession? Because people are not spending in certain establishments, in certain corners of the economy. They start getting rid of employees, people lose their jobs, they cannot pay rent anymore, and we start to see the economy dipping into a massive recession. So the recession is inevitable, and therefore we say, and we've been saying since last year, hey, Federal Reserve, Mr. Jerome Powell, nip it in the bud. There is no such thing as inflation being transitory. It never happened before. I said, and I continue to say, that inflation is like a tornado. Once you see the little cone forming, that is the moment when you say, nip it in the bud. Kill inflation now. Tighten the monetary policy now. But once that tornado lands, it becomes a self-sustainable phenomenon. And that inflation becomes stagflation and eventually becomes a recession. And all what the Fed can do is fast forward the stagflation part and move us all the way to the recession part by tightening the monetary policy aggressively. And this is where we are right now. Inflation is not going down, and this will require more aggression by the Fed, which will cause more collateral damage. More on that in a second. But consumers are also expecting more inflation to come, specifically this winter. When asked, the majority say 74% that the reason behind inflation this winter will be electricity and natural gas costs. I know what you're going to say, but hey, Maverick, what about the What about the Inflation Reduction Act? Well, sweetie, The Inflation Reduction Act is a scam. It actually causes more inflation. And now, the majority of voters agree. They got duped. Matter of fact, 1 in 4 voters now say that the bill will reduce inflation, while a larger number of voters, 34%, say that it will make inflation worse. And here's the take from Larry Summers regarding today's action. He says today's CPI report confirms that the U.S. has a serious inflation problem. Core inflation is higher this month than for the quarter, higher this quarter than last quarter, higher this half of the year than the previous one, and higher last year than the previous one. You see a trend here? He also added, median inflation used to be a favorite indicator for Team Transitory. This month, it was at the highest ever reading. This is what Larry's talking about. The line in blue, it's moving higher. The line in green, core CPI, is moving higher. The line in orange, trimmed mean CPI, is moving higher. The only thing moving down, for now at least, is the headline CPI, and the reason is the drop in energy costs. But who's to say that the drop in gasoline prices is gonna last? We might see a resurgence in energy commodity prices. That could happen easily. It happened before in the 70s, in the 80s, and it could happen again just as easily. Larry Summers also added it is highly implausible that inflation will fall to 2% without unemployment exceeding 4.5%. Yet this is the most pessimistic view among 19 members of the FOMC. Dangerous groupthink. And folks, any doubt about the Fed increasing interest rates by 75 basis points in the next meeting is now gone. 75 basis points is in the bag, and we're now talking about 100 basis points. Matter of fact, the odds for 75 went to 80%. It's in the bag. After the CPI, the odds of 100 basis points went higher to 20%. And as the day progressed, the market is pricing in 84 basis points in the September meeting. So we're getting closer and closer to 100 basis points. Therefore, the market is going down. It is adjusting. John Farrow from Bloomberg tweeted this, and he's quoting from Nomura. Materializing upside inflation risks are likely to result in the Fed raising interest rates by 100 basis points at the September meeting. We continue to expect 50 basis points hike in November, but now anticipate another 50 basis points hike in December. Folks, I've been saying this for a long time. If the Fed thinks that they're going to control inflation by 2.5% in the Fed funds rate, I say good luck. It's a fantasy. It's a dream. It's a laughable one. The way Volcker defeated inflation is by raising the Fed funds rate above the CPI. Because, folks, remember this. The Fed funds rate is at 2.5%. But when you factor in inflation at 8%, the Fed funds rate is actually negative. So you really think that they're going to control inflation with negative interest rates? Come on. Come on, man.
Come on, man.
They have to go to at least 5% at a minimum. By what? By year end. And of course, we have to quote Professor Roach because he was one of the few ones who actually got it right from the get-go. Take a look.
So to the pundits and to the Fed officials who say that inflation has peaked, inflationary pressures would abate in the back half of the year, what do you say to them? Shouldn't that be something good that can alleviate that base case scenario?
You know, I think the peak inflation rate argument is sort of a cheap argument. I mean, you know, when you go up as fast as we have, as high a level or rate as we have, you know, peaking is sort of an arithmetic, obvious outcome here. The question is where we go beyond the peak. I think inflation is going to stay above 5% through the end of the year. That would be well above the nominal federal funds rate as discounted in the market. So we've still got a negative real federal funds rate, which is miles away from neutrality, if you want to call it that, that is associated with a more even-keeled monetary policy and not even close to the restrictive policy that will ultimately be required to bring inflation down.
So he slaughtered Team Transitory right away, Team Peak Inflation right away. And listen to what he says about the dilemma of the Fed. They're not even close, folks. They're not even close to tackle this inflation. Take a look.
Well, Melissa, the stagflation scenario is something I wrote about 2 years ago in the FT, and I worried more about the supply side than the demand side. But now the demand side has really gotten away from the Fed, and the Fed has a massive amount of tightening to do, not even the markets are not even close to discounting the full extent of what's going to be required to bring the demand side under control. And so I think that it just underscores the deep hole that Jerome Powell is in right now.
And here's what I say. I say the inflation report proves that Jerome Powell will need to become Nero and burn the entire economy down. Buckle up. Why do I say that? It's really simple, folks. I've been saying this repeatedly. The Fed is a follower, not a leader. The Fed has been in the passenger seat while inflation has been in the driving seat. It's a dangerous game when the Fed says, oh, I'm too afraid to go all in. I'm going to step with one foot in, raise interest rates by 25 basis points and see what happens. Because they're so afraid. They want to treat the stock market with delicate hands. Well, honey baby, it doesn't work that way. If you're going to be too afraid to defeat inflation, well, guess what? You're going to lose to it. And until and unless the Fed tells inflation, hey, you know what? I'm going to be in the driver's seat right now. You move along and sit in the passenger seat and follow what I'm doing. How can the Fed do that? The answer is by raising interest rates above the CPI, at least, for the love of God, above the core CPI, and then guide inflation down. This is what Volcker did. It is possible, but the longer the Fed waits, the more damage we will see in this economy, because sooner or later the Fed will realize that they have to do that exactly. They have to go to 5% in the Fed funds rate at a minimum. And the problem is, by the time they realize that, we will see more and more damage in the economy. So the economy will not be able to absorb the shock. Right now, the economy has some cushion to absorb the shock. 6 months ago, the economy had plenty more cushion. A year ago, the economy had a lot of cushion to absorb tightening the monetary policy. But this cushion is disappearing by the day, and the longer the Fed waits, the more damage we will see in the economy. Folks, have we not learned anything from past experiences? Back in the 70s, the Fed tightened the monetary policy by a little bit. Inflation went down, and the Fed said, okay, we've done enough. That's it. What do you know? Inflation came back with more aggression, and the Fed tightened more. Then inflation went down, and the Fed said, okay, we're done here. Guess what? Inflation came back with more aggression in the late 70s. And inflation only went down when Paul Volcker absolutely crushed inflation by such aggression. But at that time, that produced 2 recessions, not 1, 2. Of course, Paul Volcker inherited the mess. Jerome Powell created the mess. And even former Fed chair and current Treasury Secretary, also known as Transitory Yellen, she says the Fed will need great skill, quote unquote, and good luck to bring down inflation without crashing the economy. And of course, the most spot-on recession indicator, the yield curve, well, the inversion is steepening, meaning the yield curve is saying, watch out, we have a severe recession ahead. And somebody, for the love of God, introduced Ken Klippenstein to this channel because the guy is so confused right now. He says the Fed-owned economists warn of a severe recession if the Fed keeps hiking interest rates. Fed Chair Powell, a Republican who thinks wages are too high, insists he would not cause a deep recession, but that pain, quote-unquote, is necessary to fight inflation. In other words, Ken is saying, is a recession really better than inflation? And I say, Ken, it doesn't matter. The recession is inevitable. It's going to happen either way. Now, do you want it to be preceded by a deep, severe stagflation like the 70s? Or do you want the Fed to fast forward to the recession part? Because stagflation leaves a permanent mark on the economy. Yes, back in the 80s, Wall Street did recover, but the middle class did not. The damage from the stagflation in the 70s, that was the beginning of the end of the middle class in America. Now you might say, but hey, Maverick, it's not fair that some poor and middle class people have to lose their jobs for inflation to go down. And I say, I did not design this economy, folks. This is the kind of rigged economy that we live in. When the economy does good, the 1%, the oligarchs, benefit the most. When the economy goes sour and we hit a recession, the poor and the middle class pay the price, while the oligarchs, the 1%, the corporations, we actually bail them out. And again, I did not design the system, I'm just playing by the rules. And yes, this is not even capitalism, it is gangsterism. It is an oligarchy. You want to fix it? Well, do something about it. Because now the billionaire who hired Jerome Powell decades ago says that he'd probably be happy if you lost your job. And this billionaire happens to be Rubenstein. He said about Jerome Powell, he can't quite say this, but if the unemployment rate goes up to 4% or 5% or 6%, inflation will probably be tamed a bit. But he can't come out and say, I hope the unemployment rate goes up to 6%. That doesn't sound politically very attractive to say. And the question is, once again, Maverick, why do we need unemployment to resolve inflation? And the answer is, think about it. What is the main driver of inflation if it's not gasoline prices anymore? The answer is rents. How do we get rents down? Now you might say, oh, we just increased the supply. But the problem here is this new supply will be built by what? By raw materials at inflationary prices right now. By using labor at inflationary wages. Hence, whoever builds these apartments have to charge more to be compensated for the input cost. Number one. Number two, with all of the money that's going on right now floating around, they printed so much money, and the majority of that money floated to the top. Every time we have an increase in supply of houses, guess who scoops up all of these houses? Single-family houses. The answer is so-called investors, trust fund babies looking to park their money somewhere. They scoop a bunch of homes. They list them on Airbnb or rent them. Corporations also compete in buying houses. Every time we have a new fresh supply, these corporations scoop them up right away. And they have plenty of money to do so. Not to mention, of course, that building this supply will take years and years and years. So what do we do now? Because we're all aware with what's going on around us. If you have rent right now, you rent an apartment or a house, and your landlord says, hey, I'm going to increase your rent by 20%, 25%. You know that looking for a new place is a hassle. The supply is not here. It costs a lot to move around. You have to take time off from your job. So it is easier to just say, okay, I'll pay 20% more. And you sign the new lease. And the problem is, so long as we have aggregate demand in the economy, meaning if prices go down or if somebody moves out of the apartment, the landlord can find somebody else easily and they can pay more. Rent inflation is not going to go down. Simple as that. And the reason is the demand is too high. So if we cannot solve the problem by increasing supply, we have to solve it by decreasing demand. And some would argue that this level of demand is unsustainable regardless of the supply. Even if we have new supply, it will be scooped up right away, and we will see inflation rising higher. The demand is the real problem here. How do we solve the demand problem? Well, the answer is we have to create more vacancy. The easiest way to do that is by unemployment. Somebody loses their job, they cannot pay rent anymore. They have to move out. That place becomes vacant, but it's not going to take just one person losing their job. If a lot of people lose their jobs, even when somebody says, okay, I'm moving out, I lost my job, I cannot afford rent anymore. In a recession scenario with high unemployment, the landlord is not going to be able to find somebody else to pay these insane prices. So they have to move the asking rent down until they meet demand, and therefore inflation dies. It is barbaric, no doubt about it, but what is the alternative here? Just sit and watch inflation get out of hand, out of control, and then it becomes stagflation, and we see unemployment rising higher anyway, but in a slow death kind of fashion, while prices still lingering higher, and then we head to a recession either way. That could be a deep recession, a prolonged recession, or do we want the Fed to do the job and kill inflation right away, get us into a recession, and cross our fingers and hope it's going to be a mild recession? And folks, once again, all of this was avoidable. All of this was preventable had the Fed acted last year. But the Fed last year kept saying, no. Inflation is transitory. We're not thinking about raising interest rates. And now here we are. But hey, folks, if you listened to me and you said, hey, what's up with the FUD? You're scaring everybody. It doesn't have to be this bad. Well, maybe you want to listen to the good professor, Jeremy Siegel from Wharton, who says the stock market will surprise investors to the upside, as cooling on the ground inflation means the Fed will not hike rates to extremes. But just a reminder, back in 2008, the good professor said in his forecast, don't count on a recession, but look for stocks to have a good year and Democrats to take control of the White House. Well, at least he was right about one thing. But anyhow, let's move on to cover the stock market information for you. And we start with the closing of the indices today. And here we go. The Dow Industrial Average was down big, losing 1,276.37 points, or a decline of 3.94%. The Nasdaq in free fall, losing 632.84 points, or a decline of 5.16%. The S&P 500 also down by 177.72 points, or a decline of 4.32%. The sector's performance, pathetic across the board. Everything is down today. No metals at all. Shame on all of them. And the declines led by communication services, technology, and cyclicals. The advance to decline ratio, pathetic across the board. NYSE only 5% advancing versus a stunning 94% declining. The Nasdaq 16% advancing versus 82% declining. Now usually, not always, but usually, we get such depressed reading in the ratios. In this case, to the downside, the opposite happens the next day, meaning we should see a bounce. This bounce could happen in the futures market overnight. It could happen early on in the morning. Yet the likelihood is, when we get such a day in a bear market, it's not a one-day phenomenon. It is usually followed by more and more losses. So if the market opens up tomorrow in the green, we see a gap, usually we see a gap and crap. It sells off right away. Moving on to commodities, look at this. The dollar was up big, gaining almost 1.5% in a single day. The euro was down crashing. The Canadian dollar was crashing. The Kiwi was crashing. All of these countries would experience higher inflation just because their currencies went down. But even with such massive gain in the dollar, commodities performed, I would say, pretty good. For example, energy commodities were mostly in the green. While the WTI and Brent were pretty much flattish, gasoline RBOB gained almost 1% for the day, and the party boy, natural gas, with gains of over 1%, despite the rise in the dollar. Softs were soft across the board. Losses for cocoa, cotton, OJ, coffee futures. On the other hand, lumber and sugar managed to close in the green. Metals down across the board, be it gold, silver, platinum, copper, palladium, all down. Metals tend to be more sensitive to the dollar, and therefore the trade was, if the dollar was supposed to go down, we go long metals. But if the dollar goes up, because we have a hotter CPI, and this is exactly what we got, metals is a no-go, at least for now. In meats, while we saw live and feeder cattle futures trading down, the new big tech, lean hogs, gained almost 4% in today's session. Grains mostly down, led by soybean meal, down about 2.5%. We have losses for oats, corn, soybeans, while wheat and canola pretty much flat. On the other hand, soybean oil is gaining about 1% so far. So all in all, despite the rise in the dollar, commodities are still holding, meaning inflation has such strong tailwinds that even with the rise in the dollar, commodities are holding ground. We're also following the important news regarding the strike for railroads. A lot of commodities are transported via railroads. If we have a strike, a lot of these commodities are not going to move. The supply is going to be tight, the demand is still high, prices will go higher. Moving on to the big casino, the options market. What's going on here? The hottest table by far was Tesla, the souffle, at around 2 million contracts traded today. About 53% of those were calls. Apple at number 2 with around 1.8 million contracts traded today. About 52.5% of those were calls. At number 3, Amazon with around 750,000 contracts traded today. About 53% of those were calls. All of a sudden, the volume for calls went down from yesterday's volume. This is an indicator that the sentiment is now shifting back toward the bearish side. And here are the unusual activities that took place in the options market today. We start with the ticker GOOG, the big goog. Somebody sees more downside for Google. They bought the 99 puts for the expiration date, September 23rd, with expectations that the name could move down and lose more than 6% of its value by then. They paid around 80 cents a piece to enter this trade, all in all, spending around $1.3 million. What about the ticker SPY for the S&P 500? Somebody sees more downside. They're buying, or they bought already, the 358 puts for the expiration date, November 18th, with expectations that the SPY could go down by more than 9% by then. They paid around $5.65 a piece to enter this trade, all in all spending around $5 million. What about the ticker MSFT, Microsoft? Somebody sees more downside for the name. They bought the 230 puts for the expiration date, September 23rd, with expectations that Microsoft could lose more than 9% of its value by then. They paid around 85 cents a piece to enter this trade, all in all spending around $550,000. And this is an important one at the bottom of the table, the ticker AVGO for Broadcom. Now, this is a classic insider trade because somebody knows something and they're buying a massive amount of puts. In this case, they bought the 460 puts for the expiration date, November 18th, with expectations that AVGO, also known as Broadcom, could lose more than 8.5% of its value by then. They paid around $14.50 a piece to enter this trade, all in all spending around $7.5 million. On to the heat map analysis. Do we see anything here at all? A sea of red, a bloodbath across the board with very few exceptions. Among them, Li Auto, Neo, the Chinese auto manufacturers. They have individual reasons, and then we have in energy, LNG, Cheniere, also lighting up green, but besides that, folks, a bloodbath across the board. Now, usually, when we get a bloodbath like this in the stock market, indiscriminate selling across the board, we get a rebound in the following day. Whether the rebound sticks or not, that is a different story. In all likelihood, it doesn't stick. The only corporate news that I got for you is from Starbucks. Starbucks has its Investors Day, and today they announced an additional $450 million in spending to revamp North American stores. Because, you know, they're disgusting. You can't even sit in one. They used to be nice, not anymore. And I say a good start will be installing air fresheners in the store. Most importantly, cleaning the pests. That would be nice. And how about charging less for coffee that tastes like ass, right? Because that's what it tastes like. And by the way, I only go to Starbucks to support the employees. Because I know them, they're nice people, they know me by name, they say hi every time I walk in the morning, but I don't go there for the coffee. Anyways, what about the heat map for the ETFs? A bloodbath across the board? Very few exceptions. Exception number 1 is UNG, natural gas commodities were higher. Exception number 2, the inverse indices and the VIX proxies. Everything else is in the red. A bloodbath, a massacre that unfortunately you're going to see more of. Moving on to the charts analysis, we start with the SPY 30 minutes chart. What do we see here? We talked about the risk yesterday that when they run the tape all the way till the important event, the CPI, with the assumption that the CPI will come out pleasing to them, there is a degree of arrogance in that kind of action, and that makes the risk to the downside, the surprise element to the downside. And now when the CPI came out disappointing, the reaction was extreme. We got a massive flush down. Not only the SPY lost 410 as support, it lost 405, it lost 400, and it lost 398, it lost 393.16, and now we're looking at 391 as support. The good news is the momentum indicators are becoming a little oversold. What the bulls should be hoping for is just lay it on me, give it to me, gap down in the morning. Let's get it really, really oversold, and then we bounce and close at the highs of the day. This is what the bulls are hoping for. The bears should be hoping for a bounce in the morning to resolve some of these oversold conditions, and then we flush them down again. And here's the daily chart for the continuous contract. Oh boy. Oh my God, look at this. One of those Dr. Payne candles. The SPY futures are now down at the trend line exactly. Likelihood is they're going to lose the trend line. Is it going to happen tomorrow? Is it going to happen next week? Who knows? But it's going to happen, which means the support 3,960 is not intact. We have to look down at 3,855. And honestly, folks, with this kind of momentum, with this kind of shift in sentiment, we're going down to retest the June bottom. The volume spiked significantly higher. The momentum indicators are curling down this time around. All of these are bad signs for the bulls and good signs that the ambush by the bears is more than successful. The bears have control right now. And here's the SPX, the cash index for the S&P 500. I'm showing you a weekly chart because the last hope for the bulls was the potential of a reverse head and shoulder formation. It appears that the reverse head and shoulder is kaput. It's not a done deal yet, but it is becoming highly likely that it's not going to happen. You look at the MACD indicator, the RSI, they're now curling their way down, indicating another massive leg down coming. The Qs, the Nasdaq, 30 minutes chart, what's going on here? Similar story, a massive gap down forming a bear flag. The bear flag played out and got us all the way down to 294.33 as support. Now folks, do we need to identify supports below? Not really. The next support should be the June so-called bottom. And apologies to Mrs. 313. We wanted to make it there, but it is what it is. The good news for the bulls is the fact that the momentum indicators, the RSI in this case, at least in the 30, is becoming oversold. Now, let's move on to take a look at the continuous contract for the NASDAQ, and ooh. Oh, no. Another massive Dr. Payne-like candle. The Qs lost plenty of support, the trend line is gone, and now 12,207 is gone too. The next stop has to be the June bottom. The volume went higher on a down day big time. The momentum indicators are curling down. Most importantly, let's visit the Qs, the actual Qs chart. This is a daily chart. I want you to look at the MACD indicator. You see that crossing that was supposed to happen, but now it appears it's not going to happen. The red columns in the histogram got shorter and shorter and shorter, but now we have a failure. It appears we're going to accelerate the momentum to the downside. When did we see that last? The answer is we saw this phenomenon twice in this year so far, and both of them produced lower lows. The most famous of them all is this one. Back in 2020, the crash of the thing, it appeared that the MACDs curling its way higher were out of the woods, then it changed its mind and it went down again, and that produced another massive leg to the downside. So the assumption here is we're going to get another massive leg to the downside. Buckle up. Here's the IWM 30 minutes chart. What's going on here? Gap down, bear flag, losing support. You know the story. For now, the RSI is getting oversold. We have the potential for a pop in the morning, but in all likelihood, it's going to be a gap and crap. I'll be watching for 183.25. If the IWM pops above that and then it loses that support again, that would be a shorting signal to double down. The next support would be 178.60. The dollar index, tricky Dixie. Look at this. When we assumed it's dead, it pops higher again. Now here's the good news for the bulls. Or maybe not. The dollar is going to go down. It's inevitable. It is losing momentum. The answer is it going to go down for the good reasons or the bad reasons? What am I talking about? The good reasons would be the Fed taking their foot off the tightening accelerator. That's not going to happen. The other reason, the bad reason, would be the ECB, the Bank of Japan, other central banks become more aggressive in tightening their monetary policy. That pushes their values, the values of their currencies, the yen, the euro higher, and it adds downward pressure on the dollar. That would be the dollar moving down for the bad reasons. And here's the daily chart for the old man, the mature guy in the room, gold. Well, the old man refused to rally. While everything else was rallying, gold said not so fast. As if gold was in the know that the dollar is faking it. But the good news is the dollar popped higher big time, but gold went down by a little bit. It wasn't a massive flush down kind of sell-off. The support of 1,685 is still intact. This might be crazy, but I view the action as relative strength. The dollar should have been down a lot, but it's not down a lot. The resiliency is saying something. What about Brent oil, a daily chart? What's going on here? It stopped at the sloping line of resistance exactly. Now, will crude make a higher low, forming a reverse head and shoulder formation? That would be bullish. Or is it going to cross above the line and then move down to retest that line of support that time, forming the higher low, and then proceeding higher? Both outcomes would be bullish. Is there a bear theory here in oil? The answer is not until oil loses 85 as support, hence forming a lower low. And here's the 10-year yield that popped higher again. It got almost to the next resistance at around 3.5%. But honestly, folks, the action was in the 2-year, a massive pop higher, which, by the way, steepened the inversion of the yield curve. And with the 2 years saying, hey, Fed, 3.5%, that's not going to cut it. You need to go to 4. Soon enough, it's going to be 4.5%. And then 5. Why do I say that? Here's the monthly chart for the 2-year yield, a downward trend that goes all the way back to the 80s. This trend has been reversed, and therefore we say that this is a seismic shift that we haven't seen before, at least for a long time. And the next resistance would be at around 5%. Here's the TLT weekly chart. Believe it or not, the TLT was not down by a lot because the 10-year was not up by a lot due to the inversion, or the acceleration of the inversion, I should say. Does that mean at some point the TLT would pop higher? The answer is yes, it could. Are we at that point right now? Not really. We're still below 109.5. We're still below the trend line. The momentum indicators are in negative divergence. We need to see more here before we jump in. The VIX 4 hours chart. What's going on here? We have the crossing in the MACD indicator, producing green impressions in the histogram. This is a message saying that the bearish momentum in the VIX is done. We have new bullish momentum, which means new bearish momentum for the SPY. The RSI reversing negative divergence. The problem is the VIX could not make higher highs from the previous consolidation. If it does, all of that energy will be released all the way, and we could see the VIX moving closer to 40. What about Apple? Daily chart, look at this. Big reversal, big time. All these geniuses who bought Apple yesterday, well, they got served massive warm pies right in the face today. Apple lost 157 as support. We're now eyeing 150. And folks, the volume went higher on a down day. The momentum indicators are curling their way to the downside, indicating another massive leg to the downside coming. And if Apple goes down, the market will go down with it. Here's Tesla, an hourly chart. We talked about the fake bull flag yesterday. And indeed, we got the gap down. The bulls lost 298 as support. The chart formed a bear flag pattern, and the bear flag is playing out. And the next destination would be 280. If the bulls lose 280, we have the double bottom, and after that, open the sinkhole and ring the alarm bell. And lastly, tulips. 4 hours chart, what's going on here in Bitcoin? They shook off the bulls last week with that massive downward candle. And after that, they shook off the bears by popping higher and giving everybody the false signal the false sense of security. And what do you know? After that, Bitcoin went down all the way to the neutral line. Went down big, up big. We got rid of the bulls, the bears. Who's left? Nobody. Well, the bag holders are here. But are the buyers going to show up for whatever reason? Well, for now, there is no reason for them to step in. So the bias is still to the downside because the bag holders, specifically the recent bag holders, those who got sucked in the recent rally, they're now holding it back. In all likelihood, they're going to press the sell button and accelerate the move to the downside. We'll take it one day at a time because this support at 20,000 remains strong, at least for now. It is a strong center of gravity, meaning if it is lost for good, the next move will be seismic to the downside. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? Not a lot. We have the producer price index, and that's it. And folks, it was a long day, so I have to wrap it up here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.
Don't you know this? I just wanted to know if you know.